Good morning, everyone. Hope you're well. Hope you're doing alright, guys. Today, I want to reveal to you the exercise that 10x'd my trade in profitability. Now, listen, guys. When you lose a trade, the ideal scenario would be for you to review that loss, figure out why you lost, and then never do that again. And if you do that enough over time, you reduce the amount of losses that you're taking tremendously to the point where it finally pushes you into profitability. Now, the problem with that exercise is that it is very confusing to pinpoint what is the exact reason for your loss. Because you lose a trade, you look at that loss, and there's about a million different possibilities, right? There's a million different reasons that you could blame. You could say that you lost because of the price action that unfolded before your trade, because of the price action that unfolded during your trade. You could have lost because of the fundamental news that were announced during your trade. You could have lost because of the way that you placed your stop loss and your take profit levels. And therefore, there's about a million different possibilities as to why you might have lost. And therefore, I had to develop a framework that helps me pinpoint with more accuracy the exact reasoning for my loss so I can go ahead and fix it. So today, the main point of this video is to reveal to you the framework that I had developed that helps me determine the reason for my loss so I can go ahead and fix it. So let's get right into it. Now, before we get started, I quickly want to state a disclaimer as usual. Now, guys, I keep receiving DMs from people that claim that they got offered services by usernames that resemble my username, so other people that are pretending to be me. Guys, I will never DM you first. I will never offer you any service through Instagram DMs. The only way to attend my lectures is through the link in the description. That's it. There is no other way. Beware of scammers. Let's get right into the framework that we want to talk about. Now, I categorize my losses into 3 different categories. Each of these categories present a different problem about your trading strategy and require a different set of solutions. Everything is going to make more sense as I explain further, as we go further in this video. So the first category of losses are the type of losses that hit your stop loss and then continuously go in the opposite direction for the next few days. So for example, you take a trade right now, the market hits your stop loss, and then for the next 3 to 4 days, the market is going in the opposite direction of your trade. Now, when the market hits your stop loss and continuously moves in the opposite direction, that usually highlights a direction problem, which means you are buying in a bearish market. That is the main problem. The problem with the majority of traders, or the mistake that the majority of traders do, is that they blame every loss that they take on the system that they are using. You're trading support and resistance, you lose a bunch of trades, you're like, okay, support and resistance doesn't work. Let me use ICT. You use ICT, you lose a bunch of trades, you're like, okay, this also doesn't work. Let me use order flow trading or whatever other aspects of trading exist. So you continuously blame your losses on the entry system that you are using. However, the problem is not your entry system. The problem is that you are buying in a bearish market, which means, in other words, whatever entry system you use, if you are buying in a bearish market, you will lose, regardless of the entry system. Whether you're using trend lines, Fibonacci, support and resistance, order flow or whatever, ICT, SMC, whatever entry system you use, if you are buying in a bearish market, you will lose. And therefore the mistake here, or the problem, is not the system itself, it is that you are bullish in a bearish market. Now, what determines direction in the markets, guys? What determines direction is fundamentals, right? It's macroeconomics. The reason why oil has been pushing down for the month of November so far, it is because that war between Russia and Ukraine we're starting to see an end to that war. And given that Russia is an oil exporting country, that means that as that war ends, there's going to be more oil in the market to be sold. Therefore, a higher supply of oil means a bearish oil. And that's why oil prices are going down. And therefore, fundamentals determine the direction of the markets. In 2022, GBP USD melted for 8 months through to the downside. Why did that happen? It happened because the Russia and Ukrainian war started. As a result, oil prices went through to the upside. As a result, given that the UK is a net importer of oil, import prices in the UK went up. As a result of import prices going up, inflation went up in the UK. As a result of inflation going up in the UK and import prices going up in the UK, that is bad news for the country because they are paying a lot of money in order to import all this oil and they have a lot of inflation, and therefore the pound was weak. And it led to the pound melting for 8 months during 2022. In 2014, the ECB decided to lower interest rates to 0% and start doing quantitative easing. That led the euro to melt down from 2014 to 2016. Gold in 2025 has been pushing through to the upside. Why? Because there has been wars in this year, and there has been a lot of instability in the world. We had Russia and Ukraine, we had Israel and Gaza, we had Iran and Gaza at some point, we had the government shutdown in the US. Everything was just leading gold to push through to the upside. As soon as gold made it above the $4,000 level, the war between Israel and Gaza, a ceasefire happened. Russia and Ukraine is kind of seen a solution. The government shutdown ended, and therefore that led gold to be stuck above this $4,000 level, and it's just simply consolidating. It is no longer continuously pushing up because the world is becoming a calmer place. So to conclude, fundamentals control the direction of the markets. And therefore, if you look at your losses and you see that a big percentage of your losses or the majority of your losses are caused by the market hitting your stop loss and then continuously moving in the opposite direction of your trade, it means that you are getting the direction wrong, which means that you have a fundamental problem. You don't have a technical problem. You don't have to change your entry system. You have to learn how to analyze macroeconomics, microeconomics, and fundamentals. Now, in the case in which you take an entry and then the market goes a bit in your direction, and just before it hits your TP, it goes down and hits your stop loss and continuously moves in the opposite direction, it could mean that you initially caught the direction of the markets correctly, and therefore the market pushed through to the upside, let's say, and then something happened right here that caused the direction of the markets to shift, and therefore as a result, the market melted down, hit your stop loss, and continuously moved in the opposite direction. Now, for these scenarios, if this is what you see happening in the majority of your losses, there's some of them that can't be fixed because it could be surprising. For example, you take a trade and the direction of the market is indeed bullish. The market goes up and then Trump does something, tweets something basically, and as a result, the market melts down. This is unpredictable, right? You can't predict it. And at the same time, you can't be just sitting on Twitter all day waiting for presidents to tweet so you can manage your trades. You cannot do anything about it. You will lose such trades, no problem. You have to ignore it. Now, for some other trades, it could be a little bit more predictable. For example, if I take a trade right now and I know that in 8 hours, there's important inflation news for this country, or there's important unemployment news for this country, then I make sure that at the very least, I check the output of those news when they are announced, because I know that they will be announced. This is no longer surprising. I can predict that those news might be bearish, for example, and cause the market to melt down in the opposite direction. So I will be on my phone. I don't need to be in front of the monitor or at the desk, just on my phone, checking the output of those news that exist on the economic calendar to see if it kind of shifts the direction of the markets. And if it does, if we receive, for example, bearish news in a bullish market, then I just close the trade or manage it accordingly. So if you take an entry and the market goes immediately to your stop loss and continuously goes in the opposite direction, you've gotten the direction of the markets wrong to begin with. And you have to further analyze fundamentals and determine why you got it wrong. Now, if the market goes in your direction, then comes back to your stop loss and continuously moves in the opposite direction, then there's two possibilities. Either it was surprising, unpredictable, and you cannot do anything about it, or it could have been predictable because the news that turned the market bearish exists on the economic calendar. So you could have seen it and basically verified its output when that time comes and decided what you would be doing next, whether you would be closing that trade or managing it, or maybe leaving it open if the news were bullish and with your direction. So that's it for the first category of trades. Let's go to the second one. Now, the second category of trades is, let's say you take an entry right now, you take a buy, the market goes down, hits your stop loss, stagnates for a bit, creates another buy setup, and then goes in your direction. Right? I see this in a lot of track records and definitely existed in a lot of my trades. Now, I will give you a very specific example that you can go and verify on your charts. USD CAD, 5 September. It was a Friday. NFP was announced and the unemployment rate in the USA was announced. The unemployment rate was 4.3%, which was the highest unemployment rate the USA has experienced in 4 years. NFP, we predicted that we are going to add 75,000 jobs to the markets, and instead we only added 22,000 jobs to the markets. And therefore, those were very bearish news for the US dollar. So any sane person would say that, okay, those are very bearish news for the US dollar, and as a result, we expect the US dollar to weaken. Now, the problem is that if you sold on 5 September, you would have lost, because the market, instead of going down, it went up from 5 September all the way until 11 September. For these 5 days, it went up instead of going down. On 11 September, the market then melted down impulsively to the downside from 11 September all the way down to 17 September. So in that case, if you would have taken a trade on 5 September to sell through to the downside, and the fundamental direction would have been correct, it is bearish, you would have lost that trade, and then the market would have stagnated for a bunch of days, and then on 11 September, the market would have started impulsing down, which means that another entry would be offered in the upcoming days, and then you would take it, you would sell through to the downside, and then the market would go in your direction. Now, what is the difference? In both cases, in 5 September and in 11 September, we had the same market circumstances. Unemployment rate was at 4 years high. NFP added 22,000 jobs instead of 75,000 jobs. In 5 and in 11, we had the same circumstances. Nothing changed. And therefore, why did the market not push down on 5 September, but push down on 11 September? The fundamental analysis is obviously right, because eventually the market went down. However, one trade didn't work out and the other one did. What is the difference? So there's two phases, basically. The phase from 5 to 11, and then the phase from 11 to 17, because the market melted down from 11 to 17. The first phase from 5 to 11, I call it the manipulation phase, which is the market is bearish, however, it is pushing bullishly. It is pushing in the opposite direction. I call that the manipulation phase. And then from 11 to 17, which is the market melting down impulsively, I call it the extension phase. So I divide the market, to summarize, I divide the markets into two phases. The manipulation phase and then the extension phase. And I simply identify them by looking at fundamentals and seeing if the market is moving in the opposite direction of my fundamental analysis, it means that the market is in a manipulation phase. Or I could be wrong about my fundamentals, of course. So I reanalyze my fundamentals to make sure that I'm seeing everything correctly. And if I'm pretty confident about my fundamentals, I believe that market is bearish. However, it is pushing up. then I identify that this market is in a manipulation phase. And then the phase that comes after the manipulation phase, which is when the markets start moving in the direction of my fundamental analysis, this is the extension phase. Now, when you take a trade during the manipulation phase, you lose. And when you take a trade during the extension phase, you win. So my job as a trader at this point is to not only read fundamentals, but identify whether we are in a manipulation phase right now or we are in an extension phase. Because as I said, if I identify that we are in a manipulation phase, then I would avoid trading, even though I have a certain fundamental bias that I'm confident about. And if we are in an extension phase, then I would go ahead and trade. In other words, I need to wait for the manipulation phase to end before I can trade. Now, how did I accumulate enough knowledge to be capable of assessing whether we are in a manipulation phase or we are in an extension phase? It is simply by looking at my data. Let's use that USD CAD example. Let's say I took a trade on 5 September and I lost it. And then I took a trade on 11 September, but this one I won. I will look at both these trades and be like, okay, what are the circumstances that surround the trade number 1? And what are the circumstances that surround the trade number 2? And I will get into more details here. But by identifying those different circumstances, I then compare them together. I'm like, okay, how is trade number 2 any different from trade number 1? Once I figure that difference, then I'm like, oh, okay, so if X still didn't happen, it means we are still in a I will get more specific with it. In 5 September, when I looked at the chart, I've seen that the market is stuck between a bunch of highs. Right? There was a lot of highs right above where I would have sold on 5 September. So I assumed that right above these highs, there would be lots of stop loss areas. So I knew as a result of that, because I've seen it in my data a lot, that this trade would be a loser if I take it. That we are right now in a manipulation phase, and these stop losses are going to be taken before we extend through to the downside. You can go to your charts and look back at 5 September USD CAD on the 2 hours time frame. And you'll see that there was a bunch of highs right above where we would have taken a trade. And therefore from 5 to 11, we went up, we liquidated these highs, therefore ending the manipulation phase, and then the extension phase started. So in that case, I would take trade number 1, let's say I lost on 5 September, and trade number 2 on 11 September, and I would compare them. I'd be like, what is the difference between those trades? Both of these trades were taken in a bearish market. However, one lost and one won. All right, what is the main difference? I'll see that trade number 1 had a bunch of highs right above it. However, in trade number 2, that didn't exist. And therefore, I'm like, okay, when there's a bunch of highs above my trade, that could possibly mean that we are in a manipulation phase and I shouldn't be trading in those circumstances. So then, when the circumstances of trade number 1 show up again, I wouldn't take a trade in those circumstances. I would wait for trade number 2's circumstances to trade. And with that, so simply all you need to do is take a bunch of trades, lose some, win some, compare the losers to the winners, see the circumstances in which the losers exist in, and the circumstances in which the winners exist in, and then you'd be capable of understanding, all right, when those circumstances emerge, I'm not going to trade. However, when those emerge, I'm going to trade because we will be in an extension phase. And therefore, to conclude, if you look at your losses and you see that the market, for the majority of your losses, let's say, hits your stop loss, stagnates for a bit, creates another set of setups, and then pushes in your direction, it is simply a timing problem. You've traded in the manipulation phase, lost, and then the extension phase gave you a winner. Now the last category is the easiest one to spot, and I see it in a lot of track records. It's also very frequent, which is a trader takes a trade, and then the market simply goes down, hits his stop loss, and then impulsively pushes through to the upside immediately. It's like a wick, really immediate movement, a wick to the downside, and then boom, in the opposite direction. Now, that is not a problem of manipulation phase versus extension phase and everything that I just mentioned, because that could happen in an extension phase where the market is extending in your direction to the downside. However, you take a trade, the market wicks to the upside, triggers you out, and then continues moving in your direction. Now, for this specific category of trades, it is the easiest one to deal with. If this is how the majority of your losses look like, all you need to do is just extend your stop loss size. A lot of you guys are very attached to like high risk to reward ratio trading. You want a 1-to-5, you want a 1-to-6, and therefore what you do is you tighten your stop loss as much as possible so you can get the highest risk to reward ratio possible. If you are losing as a result of the market wicking through your stop loss and then moving impulsively in your direction, your stop loss size needs to go up. You need to increase your stop loss size, sacrifice that risk to reward ratio a bit. It's okay, because when you increase your stop loss size, guys, your win rate will go up because the market will no longer hit your stop loss and impulsively move in your direction as much as it did before. And therefore, you'll make up for the sacrificed risk to reward ratio. And therefore, you shouldn't fear sacrificing your risk to reward ratio a bit for the health of your stop loss size. As I said, the third category is the easiest one to deal with. If the majority of your trades are losers as a result of the market wicking through your stop loss and then moving in your direction, increase that stop loss size. It's totally fine. Nothing bad will happen. Now, those are the three different categories that I put my losses in, and this is how basically I deal with them. And they include every trade that you might lose. So that's it. I hope this framework is helpful to you guys. Let me know down in the comments if it is, and I'll see you guys in the next video. Goodbye.